Thanks for joining us here on the Market Day Report. I'm Marlin Bohling with you, your tour guide to the ag commodities. Let's review where we now stand on our ag trade with our quotes provided by Bar Chart. Let's go to the corn board here and take a look at what's going on, shall we? On the big board, we have the May corn drifting lower by 3 cents, and now we're at 663 1/4. You can't decide what he wants to do. It's been higher and lower since overnight. December corn currently 1/4 cent higher at 560 1/4. Well, soybeans had a big move this morning out of the gate. They had double-digit gains for a little while, and now you have May kind of cooling its jets a little bit. We're 7 1/4 higher yet at 1507 3/4, and November now 7 3/4 higher, and it's at 1309 1/4. Well, the big question mark this morning was the wheat trade. What would happen there? And, you know, I'm not sure if it knows. In Chicago, you have May wheat a penny higher at 683 1/2, and July is up a penny and a half. However, you get to Kansas City, and this is a whole different story. Now, look at May dropping 9 cents at 869 3/4. July is down 7 1/4. With the cold weather moving in? Question mark? What? All right, let's take a look at the Minneapolis wheat on the May contract. Whoops, let me hit the right button here. On the Minneapolis wheat, you have the May contract 5 1/2 lower at 870 3/4, and July is down 6 at 867 1/4. We are joined in-house by Chris Swift of Swift Trading. He's based in Nashville, sitting right here. Always a pleasure to have Chris come in and talk about the markets. I'm very confused. we had several countries in Eastern Europe saying, we don't want Ukrainian grain going through here.
All right.
No more. And you have wintry weather affecting, Jim is talking winter weather in Illinois, where corn and soybeans are in the ground already, and some of the soft wheat is in the boot stage. And yet Kansas City wheat, for example, is down 8 or 9 cents. I don't get it. What is going on?
I don't either, really, but probably a lot of spreading more than anything. If you look at it from Friday's trade, we were up 35, 36 cents in Kansas City, only up 10 to 15 in Chicago. This morning, we reverse it back. A lot of that has to do with the dry weather out in the Midwest there. There is clearly no break in it whatsoever. But yet, if you look at how centralized that is, everything else outside of that's in pretty good shape. So I think that's what they're kind of looking at is, we may lose that real central portion there that is burnt the most. And when you look at a map, that is a large portion of the acres, but there are significantly more acres outside of that worst drought spot.
Let me bring up this corn table once again, and we'll take a look at this here on screen on the corn prices. And okay, so you have nearby May corn down 3 1/4. December, the new corn that's in the ground, shivering its little corn feet off, it's up 1/4 cent at 560 1/4. That's not much premium for a weather scare.
Well, it's not, and you don't really have that big of a weather scare. You got 3.5 million more acres anticipated to go into the ground this year than last. The real big interesting thing is watch what the price is. Notice that big discrepancy between May and July. As soon as we get May, I think May 13th or 14th is when that goes off the board. You're already going to be in first to notice day at the end of this month, and you're fixing to take a 30-cent hit. If you don't get that grain marketed, or you see between May and July the price of corn go up 30 cents, fixing to lose 30 cents real quick, like in less than 2 weeks.
Can you explain why soybeans are going up like they are?
I'm not real sure. I haven't seen a lot. I think today's just the first day that they've been up to any great extent. So, no, I think they're just kind of sideways and meandering, really. A little bit of time and meandering. Yeah.
That's my favorite word.
Any corn that doesn't go into the ground, then beans will follow right in behind it.
Interesting stuff. All right. So old crop, new crop spreads are probably going to continue to...
all the rest of this year.
Wow. Okay. We'll come back in a moment, and we'll go ahead and take a look at what's going on in livestock right after this. Okay, I want to start out this segment looking at the U.S. dollar index value. Let's bring that up here and see what it's doing. Wow, Chris, we have the June futures up 570 points this morning, and we're at 101.810. We're getting close to 102 again. The conventional thinking is that when the dollar goes up, it makes it harder to sell U.S. ag goods. Still true?
Probably, but you got to remember these are right at the low end. These are contract lows that you're just coming off of. So the dollar has been very, very weak over the last several weeks. So I think that should be helpful. You know, it truly has been beneficial to the crude oil and gasoline. That's for sure, because both of those have been soaring straight up.
That is true, yes. All right, let's take a look at our live cattle trade right now. We'll see what's going on so far today. Well, it's kind of firming up here. June live cattle up 72 at 164.45. Within a dime of our high of the day now. August is 45 higher at 163.15. On the feeder cattle, you now have the May contract. Wow, look at that, up $1.92 at 209.82 within a dime of its high of the day. So does that mean new contract highs or not, Chris?
I think in the April contract, it's very close to it. We sold off pretty sharply on Friday, but those were Thursday was the contract highs for them, and so it's wild.
So do you see more ahead to the upside?
I think there'll probably be higher trading in the cattle market. Interestingly enough, although we are lower than last year, beef production's dead in line with the last 5 years. We're $25, $30 higher in box beef with the same number of cattle that we've been at for the last 5 years. We're just a little bit lower than year over year. So very interesting how we see such a very small impact in supply have such a great impact on price.
So what drives that, do you think? Why?
I think it's consumer demand. I think it's just a lot of money out there. Note that gasoline's been going up. That's a consumer product. Diesel fuel's been sitting there with industrial, railroads, airlines, shipping, and trucking dead as a doorknob. It hadn't done anything. Gasoline shot straight up. I think that's still the consumer speaking with their pocketbook. They've either got lots of subsidy money still coming in, or they still have lots of money left over from the $4.5 trillion sloshed out there.
So now, if memory serves correctly, last time we had a CPI number that came out, it was showing lower inflation, but that was because they were talking lower energy costs, and now it's going up.
And now it's back up right up at the highs.
If you see meat prices going up like that, I mean, I would imagine that would probably tend to be going up.
And they are going up. And you know, we on the side of where we see the reports, they're all in tenths of a percent, but you and I don't ever see that when it's at the grocery store level there. No. It just consistently goes up. So.
No, we were eating out at restaurants over the weekend.
Ooh, I bet that stung.
You can tell. Yeah. Let's take a look at lean hogs, and then I'll let you go. Let's go to the lean hog trade right now, and on the big board. Oh, look at that, man. Lean hogs, they're higher by $1. You don't see that very often. 81.45 right now. 15 cents off our high of the day, and pretty much off our low by, what, about 75 cents or so, 70 cents. So a little rebound in the lean hogs. They have a little spring in their step today. All right, well, thanks for coming in, Chris. Good to hear from you again.
Always a pleasure.
And see you in person, so I'll let you go for now. But Chris Swift of Swift Trading in Nashville. Tammy, back to you.